I'm Cynthia Rowland, and this is episode 160 of EO Radio Show. This is the third of 3 episodes focusing on gift acceptance policies for public charities. In episode 158, I introduced gift acceptance policies and why policies matter, what they are, the governing principles, and who should make the decisions at each step of the gift acceptance process. In episode 159, we talked about the spectrum of gifts. Well-crafted gift acceptance policies will cover the various types of assets that the organization wants to pursue. These range from the easiest gifts, gifts of cash, to those that are a little bit more complex, like real estate, and to the most complex, things like cryptocurrency, private company interests, and the like. In this episode, we're going to focus on the aspects of the gift acceptance policy that will touch on IRS compliance, donor recognition, and implementation of the gift acceptance policies. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. Today, we're going to close the loop on our gift acceptance policy and cover things like the IRS compliance requirements, some stewardship concepts, and how to make the gift acceptance policy live in your organization as an evolving policy that meets the organization's needs. As we all know, it's relatively easy to ask your favorite AI tool to spin up a gift acceptance policy. The devil is in the details, though. It's really important that the policy suits your organization. A generic gift acceptance policy may not be appropriate for you. So hopefully these 3 episodes will help you to assess whatever your favorite tool has spun up for you or whatever model form you received from other people in your network and make it a useful document that is part of your organization that makes sense. So with that, let's talk about the IRS mechanics. It's really important to get the substantiation right. The gift acceptance policy should have detailed information about the duty of the organization to acknowledge the gift to the donor. Every individual donor must receive a contemporaneous written acknowledgement for every contribution of $250 or more to the organization. The gift acceptance policy should be clear that the contemporaneous written acknowledgement will describe the date of the gift, the asset contributed, that is, whether it was cash or non-cash property, and if non-cash property, a detailed description of what that property is. And the contemporaneous written acknowledgement should also include a specific statement as to whether any goods or services have been provided by the organization to the donor in exchange, and if so, the amount or value of the goods or services provided to the donor. Episode 157 of EO Radio Show has a detailed examination of how the contemporaneous written acknowledgement requirement can go awry. But for purposes of your gift acceptance policy, it's really important that these specific statements be described there and that the development staff understand and have a mechanism in place to make sure this is done for every gift of $250 or more and every time that the acknowledgement meets all of these requirements. Second important thing to note in the IRS compliance section of your policy is that the development staff needs to be aware that IRS Form 8283 must be completed by the donor and must be signed by the donee organization before the donor files their tax return for the year of certain contributions. Now, this Form 8283 only applies to non-cash gifts amounting to more than $500. In addition, there's another step here. A qualified appraisal is generally required when the gift exceeds $5,000. Now, that appraisal is a burden of the donors. It's not the charity's problem. The charity doesn't need a qualified appraisal. A footnote there, often the organization wants to see the appraisal so that you know what amount to book the gift at for your financial statement purposes. But the qualified written appraisal is a very specific requirement for the donor. So a good gift acceptance policy will highlight the need to raise this issue with the donor, that they need to have set up a mechanism for obtaining the appropriately filled out IRS Form 8283 before the donor files the return. Now, the next IRS form is a form that the organization, that is our donee charity, must file, and that's IRS Form 8282. The charity has to file a Form 8282 if it disposes of charitable deduction property within 3 years of receipt. And they must file it within 125 days of the disposition. So there's 2 timing requirements there. Anytime the organization receives a gift of property other than cash that it disposes of within 3 years of when it received it, then it has to file the Form 8282, and the Form 8282 is due 120 days after the disposition. So if you sell it within the first year, whatever that date is that you sell it, you then have 125 days to file the Form 8282. And this is basically a form that the IRS uses to match to the donor's charitable contribution claim for deduction, because many types of personal property that's given to a charity is subject to complex charitable contribution rules. And when the organization that received it disposes of the property, that may affect the donor's original deduction. So anyway, back to our policy, the policy needs to call out to the organization a reminder that it needs to calendar filing this Form 8282 and have a mechanism in place so that this filing requirement is not missed when you receive a gift of certain kinds of property that require this follow-up reporting. Then the final IRS form to keep in mind is your IRS Form 990 has a Schedule M that must be filed with the charity's IRS Form 990 if it receives more than $25,000 in the subject year in non-cash contributions, or if it receives art, historical treasures, or qualified conservation contributions. So this Schedule M is an extra schedule for your Form 990. So moving on from the IRS requirements, I want to talk a little bit about donor recognition, endowment restrictions, and some administration topics. Most gift acceptance policies specifically state that the organization will not pay any fee for the right to receive a gift, and no employee may accept compensation or a material benefit from a donor in connection with a planned gift. These concepts are also sometimes covered in the organization's code of conduct. The next thing I want to talk about a little bit is having provisions in the gift acceptance policy that address donor recognition for their gifts and include protection for the organization if circumstances change. We're all very familiar with donors who give gifts and want their name on the building. That's fine and dandy, and many, many capital campaigns include those sorts of naming opportunities. However, it is very important that the gift acceptance policy make it clear that in the course of approving gifts that come with donor recognition, the organization will need to retain the ability to remove the name from the building under certain circumstances. For example, when the building is demolished or substantially renovated. I've seen situations where the family members, it's usually descendants, because this usually happens many, many years after the original donor made the gift. And family members can be very upset if the building with their parents' or grandparents' name on it is demolished and the recognition suddenly goes away. So it's very important that the gift acceptance policy provide an outline or a roadmap as to how the staff should address this topic with the donor, either have a time limit on whether it's 100 years or however long, or until the building is demolished, but to allow the organization the flexibility to no longer recognize that donor when a new building has to be built and funds need to be raised for that. So that's a really important and very sensitive topic, but can save organizations a lot of legal budget and angst when dealing with family members 100 years down the road. The other thing to note about donor recognition, and that I'd like to see in gift acceptance policies, is that the baseline should require that in any gift that includes donor recognition, there will be a morality or naming clause, or what we sometimes call a bad boy clause. And that is what happens to the naming rights if the association with the donor becomes inconsistent with the organization's mission. Probably all sophisticated fundraising staff are aware of situations where a charity has had to return money to a donor or simply remove the recognition when a donor, his or her family or his or her business, comes into disrepute, and it can have a very negative consequence for the charity. When this is faced up front and is built into the gift agreement, everybody expects that will never happen, but having it in the agreement can save a lot of time and money if something untoward comes to light decades or further down the road. So that is an important thing to see in your gift acceptance policy. The next thing I want to touch on is endowment mechanics. A good gift acceptance policy will distinguish clearly between board-designated endowments and true endowment funds. All fundraising campaigns that even think of using the word endowment should be carefully thought through as to whether that's intended to be a true endowment under the standards that are set forth under the Uniform Prudent Management of Institutional Funds Act, or whether it's intended instead to be a rainy day fund set up by the board where the board can invade the principal if necessary. We have other episodes that focus on MIFA, but for purposes of today's talk, I just want to call out that the gift acceptance policy should be very clear that gifts that are phrased as endowments should be scrutinized very carefully at the time of the gift to be very clear whether the restricted purpose is intended to last in perpetuity and what the exit strategy is if the restricted purpose becomes impractical or incapable of being fulfilled. So it's very important to address that up front and to be clear with development staff that the default should always be that no donor gift is truly a permanently restricted fund. There should be a very specific mechanism for releasing that restriction if the purpose becomes impractical. Usually we see that as the default language being that the charity board itself can release the restriction. And if that's in the donor gift agreement, that's fine. You don't have to go to court and there's not going to be a dispute. So hopefully your gift acceptance policy includes very specific language here. Final topic, how do we keep our gift acceptance policy current? And what do we do to ensure that it's consistently implemented by all staff over all time? As I mentioned, tailor your gift acceptance policy. Don't just copy it. Whatever form you start with, it's essential to reconcile the policy with your organization's bylaws and other policies and to tailor it to the gifts the organization actually solicits, actually wants to receive, and actually can administer in a feasible and reasonable manner. Like all other board policies, your gift acceptance policy will benefit from periodic review. As circumstances change, laws change, and new types of assets appear, the policy should change and be brought current. For example, 10 years ago, we didn't have cryptocurrency in our gift acceptance policy. Next point is the policy is only useful if the organization can follow it consistently over the long term. Choose provisions and choose assets that actually fit with the operations of the organization and the abilities of your staff. So I hope the takeaway from these 3 episodes is that in crafting your gift acceptance policies, you'll look for phrasing that creates clear guidelines for each step of the way and has a thoughtful review process that will let the organization confidently navigate complex non-cash gifts so that each accepted contribution strengthens the mission and doesn't divert from it. So with that, be sure to check the show notes for links to the resources I've mentioned and the other useful episodes on these topics. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.